Good afternoon and welcome to the Markets in Motion panel. My name is Jim Angel. I'm a finance professor here at Georgetown. I've been here for 28 years, and my specialty is studying stock exchanges. I've been to 75 exchanges around the world. My mission in life is to visit every stock exchange in the world, because that's how I learn, by actually visiting, by watching the traders, sitting on the trading desks, and figuring out how these things work. Along the way, I've been chairman of the Nasdaq Economic Advisory Board, and I've sat on the boards of directors of the direct edge exchanges. Also along the way, I'm a co-inventor on 12 fintech patents. Now today we have an amazing panel put together. We have Nandini Sukumar from the World Federation of Exchanges, Bryan Harkins from the CBOE, Tal Cohen from Nasdaq, and Chris Concannon from MarketAxess. So without any further ado, let's get started. Right now, we're in the midst of a oh, and by the way, Nandini Sukumar is joining us by audio. So, so you won't see her live, but you will get to hear her. But right now, we're in the midst of an amazingly horrific pandemic. So I guess the first question is, what is the impact on the exchanges? Who'd like to start?
I can jump in and just provide a couple of observations. Just for us over the last, say, 8 or 9 months, there's really a few things that have been brought to light. One is all of us got to work from home. 98% of NASDAQ was home during the height of the crisis, and the markets worked fine. And that was, for us as a marketplace, as an industry, an epiphany where we can work from home, still be really productive, run our markets at the highest levels during the height of volatility and uncertainty during the markets. And the markets effectively were part of the solution this time around, at least during the height of the crisis. And then as we kind of made our way through, we've seen not only in equities, but in options, retail come into the market in a way that they've never come into the market in the past. So that's been exciting to see a lot. If you look at Robinhood figures and others, a lot of them are newer investors, younger investors. So we and others have been focused on investor education and advocating for investor protection along the way to make sure that that experience for retail investors is positive. And then the third is really we've just seen an acceleration of trends that existed before COVID and the pandemic, but now are just being accelerated throughout. So that's embracing emerging technology. We're having a lot more conversations about the cloud and addressing technical debt within our industry, not just at NASDAQ's level, but at all levels of the industry. So that's really interesting. And then finally, you've seen this bifurcation of the old economy and the new economy. And for us, we look at the NASDAQ 100 as a signal of the new economy, and it's really been interesting to see the sector dispersion that's happened over the last 6 or 9 months. Now with the vaccine potentially on the horizon, you've seen some of the stay-at-home stocks come back down, old economy stocks come back, but really that dislocation between the two has never been greater. So that's been a part of the theme that we've seen in the markets over the last 6 to 9 months.
I'll jump in. Thanks, first of all, Jim, and to Georgetown for having me back. Just to add on to a couple of things that Tal said, the rise in retail has been really unprecedented. And, I can't necessarily say it's because of COVID, but certainly that been a catalyst with all work from home. There's a lot of theories in the exchange world that because there's no sports, that a lot of people are, kind of playing around in the markets. I also think whether the volume is here to stay remains, but certainly the nature of investing has changed. As Tal mentioned, if you talk to the big retail brokerage, the types of accounts that are being opened is much smaller. It used to be tens of thousands, now it's a few $100, and we're seeing that type of volume in the market. The other things I would add are really just we're learning about the portability of our industry. Not necessarily just the work from home aspect. That's clear. Every industry is certainly adapting there, but it's also, in the midst of this crisis and it's creating budget crisis. I think you read the news around potential financial transaction tax. So I think all the exchanges were really self-reflecting on how portable our business can be. and potentially moving our exchanges to different state jurisdictions. And obviously there's going to be a lot to be playing out there, but certainly COVID has been certainly a catalyst for a lot of these budget crises that are causing the exchanges to kind of think about what's best for the industry as a whole, because this transaction tax could potentially be quite detrimental to the end investor. And then lastly, I'll mention we talked a lot about retail, but I actually think the irony of COVID with respect to institutional trading has been, because up until recently with the vaccine, there was really no end in sight. And then you had the election uncertainty. So we had this huge institutional flow just completely on the sidelines throughout the summer, really, where a lot of the big asset managers just lacked a directional view on the market because really the election and the lack of a vaccine. So we're starting to see that change over the last few weeks, but I thought that was quite interesting amidst all the volatility.
And if I could just add to that, thank you, Bryan and Tal. I think you did a great job, and we're going to leave Chris for last to tell us all how the fixed income market has conquered us all. But I think for us, at a global level, apart from the fact that, yes, things went remote and market infrastructures in general went remote overnight. And it isn't, we've had a very resilient, for the most part, couple of first wave of the pandemic, and that isn't an accident. It's because people have worked and prepared for that. But one of the most interesting phenomena we saw, which we haven't seen before, we haven't heard before really, is that this time around, when volatility mounted in the first couple of weeks, etc., there were calls to close the market, there were calls to close exchanges, and there were calls to reduce trading hours, and that's relatively new. And it wasn't only a small emerging or frontier market. You saw this kind of perception sweep through markets through the world. And the answer to that, of course, is it's wrong. It's the wrong policy incentive. You're relying on your exchange to stay open for business, to abide by the rules defined in its order book, etc. So that was something we really saw work through in the first couple of months. I think that the industry has made its point. I think regulators came in. You saw statements from IOSCO, who are, the global regulatory body. The SEC and the CFTC are both members of IOSCO, etc. And there's this kind of united call from the exchanges and from regulators to say, no, you don't trim trading hours, don't close the market. What was almost as interesting for us at the global level was to see what didn't change. And I know you asked, so the fundamental role of the industry didn't change. And if you think, if you define it as, say, risk transfer, price discovery, and funding mechanisms, all of those didn't change at all through the pandemic. And if you look, for example, at June 2020, companies raised over 31 billion US through IPOs, and that's still, one of the highest monthly amounts observed in recent years. What are the trends that are staying through the first and second wave of the pandemic? The move to retail, both Tal and Bryan have mentioned it, but you're seeing that not just in the US market, you're seeing it in every market, pretty much across the WFE, firmament. And, as you know, a third of our membership are in Asia Pacific, a third are in EMEA, where we have Africa and the Middle East as well. And you have, of course, the US and the central, LATAM markets within the WFE as well. So you've seen this kind of move to retail. And what we also are seeing is therefore an increased focus at the exchange level around, financial literacy, around investor protection. And that, I think, will be kind of a very substantive theme of the next year. Because people are having, side by side with retail goes the investor protection mandate that exchanges have. So finally, the last panel we heard of Akas Samad from FTSE was talking about ESG. And that's something also you've really seen play out through the latter part of the pandemic, or the last couple of months. In terms of bond issuance, the market's been on fire. It's been social bond, it's been pandemic bonds. So there's been an enormous upsurge in that. And there has, I think, not just because it's been a time that we have all been reflective of the world we live in, not just because we are thinking about what we have always taken for granted, but there has been, that increased interest in ESG. ESG has been becoming mainstream kind of as an investment and in terms of policy conversations over the last 3 years. But I want to say in the last 3 months, 4 months, you've really seen now almost like the COVID conversation begin to merge, it feels like sometimes, with an ESG conversation.
You mentioned bonds, and we all know the bond world is a lot bigger than the equity world. So let's figure out, where's the bond market going? What's the bond world going to look like over the next 10 years? So Chris, I think you might know a little bit about it. Why don't you tell us about it?
I'll try and answer that. And yes, you did point out the correct fact that the bond market is several times larger than the global equity market. But it is years behind in terms of the adoption of technology and the adoption of electronic trading. And so MarketAxess sits at the beginning stages of that evolution that's happening in the bond market. And we witnessed something unique during the pandemic when there was this mass move to work from home and trade from home. And if you think about the traditional both dealer desk and institutional trading desk in the bond market, there's still phone turrets. They still use phones. They still use institutional chat services. And it's very different than the look of what equities and options trading desks look like today. So when they moved home, there was a higher, there was really an acceleration of electronic trading adoption that we saw and witnessed. Because it's just easier from your home trading computer to launch a strategy on an electronic platform or replicate what you do over the phones on an electronic platform. And so we certainly felt the benefits of that. But as Nandini mentioned, the early stages of the pandemic in the mini financial crisis in March, we certainly saw a race for liquidity, a search for liquidity in the bond market. Many of the banks were concerned and started withdrawing their willingness to make markets, or their willingness to provide sizable liquidity. And so the institutions were racing around looking for alternative liquidity sources. And we are privileged enough to have a very large all-to-all market where both buy-side and non-traditional dealers participate. And so they were a huge part of the liquidity solution during the early stages of the pandemic and the financial crisis. So a lot of that is sticky. We get asked a lot of questions. Well, when there's a return to the office, will the accelerating trends subside, or will things go back to normal? And they really don't. We've seen conversions in other asset classes to electronic adoption, and people don't go back to using inefficient means of execution. So the changes that happened during the pandemic are semi-permanent. And then if you look at the changes for all of us and working from a variety of different areas, I think many of those changes are going to be more permanent than we even suspected as we slowly go back into offices at some point.
Well, let's turn to the international space. How is the battle over Brexit going? How is it affecting international financial markets? Is this spat between the EU and the UK going to cause collateral damage elsewhere? Nandini, what do you think?
So this is the easy question that Chris said I was getting a softball question, so this was clearly it. So I think that to start off, and I speak to you from a very bleak London afternoon where, not only does it go dark at 4 p.m., the weather's bad, but on a very fundamental note, apart from COVID, this is a region that we've all been living Brexit now for the last couple of years. And we are at this point really a very long way from an agreed international system to facilitate, really many-to-many, for lack of a better word, recognition of each other's regulatory systems. So if you think about it, like Brexit is in reality a bilateral process, just as the EU-Swiss relationship is, a bilateral process. And sometimes when we talk about Brexit, I think, well, think about the Swiss, because that's a very meaningful, the Swiss-EU relationship is a very meaningful relationship, and one, which is not, I think, also making as much progress as both sides would like. So there are common issues, if you think about, cross-border regulatory arrangements in general, there are serious questions, definitely, around policing of activity, around potential taxpayer liability. But, ultimately, these relationships are bilateral. And financial services, we live this world where we're also focused on Brexit, but financial services are ultimately a pretty small part of the overall kind of broader discussions, which fundamentally involve things like trade and freedom of movement. So we are, especially as a global organization, we're kind of very focused on what are the transitional arrangements that members at exchanges can make to ensure that there's minimized disruption, etc. And to some extent, I think there has been progress, but there is no way of kind of hiding from the fact that it is, not the world that we lived in, 2 years ago, and we're not talking about COVID, and we are not going to live, in that world again for a very long time, indeed. And if you think from where we sit, if you think about the market fragmentation conversations that we've all been having around equivalence, around mutual recognition of regulatory regimes, around deference, all those fun things that have made it possible, for the world to grow increasingly global over the last 20 years, all of those things are being, essentially rolled back. So you are, I think, in a regulatory situation now where market fragmentation is no longer viewed inherently as a bad thing, unless it compromises regulatory objectives. So for example, unless systemic risk or there's market integrity or investor protection issues, at hand, the burden of proof now is on the industry, to demonstrate how market fragmentation, causes such harm. It's not, I think, on regulatory policymakers to demonstrate that they value, cross-border cooperation or collaboration or any of the things that we have really all kind of in this industry spent the last, 15 years talking about.
Jim, I would just add that, whenever you see organized regulation across, a region start to break apart because of separations like we're seeing on Brexit, there's an element of both regulatory competition, but also regulatory arbitrage. And I do think as things play out, depending on where you sit, whether you're an EU zone or in a UK zone, there will be differences. It will be more complicated to navigate all of Europe, including the UK. Whether it's your license is being recognized in the EU, the policies of the various regulators will be different over time. So it just will be more difficult to navigate, but there may be some benefits to that over time as regulators respond to other regulators who are making it simpler and easier to work inside a certain jurisdiction.
Well, speaking of jurisdictions and international regulations, it's often said that data is the new oil. And we see the never-ending battles over market data, taking place not just in the US, but in the EU as well. Now, the EU would love to have competing consolidators of their market data, but they don't want to have a consolidated tape association like we have. And in the United States, we see the Securities and Exchange Commission saying, hey, let's have multiple consolidators. So what do you think? Who wants to take that one?
I'm going to let everyone have their say on this one. I just want to say something quickly on the start of this. I'm glad you used the analogy of oil, because it is a good analogy. And you know why? When oil comes out of the ground raw, it isn't the oil that everyone wants to use, right? And if you have the same, so the oil that people pull out of the ground, sure, fine, everyone's happy everyone's happy to have it. And then, but what really makes oil work is the work that the industry that mines it and refines it does. And if you look at market data, that is exactly what happens. Market data as we know it, that people want for free, is a product of the exchanges. It's created by the exchanges. And there's some sort of, I won't say it's an urban myth now that, that market data is somehow, not the exchanges. It's a joint product, and there's plenty of data that's available for free. If you go to the WFE website, you'll get some of it. It's not free, even at the WFE website, because we pay someone, we spend time and resource cleaning it up. The members all contributed free, and we clean it up and put it together. There's plenty of free data in the world, but nobody wants that data. The data that everyone wants for free is the data that the exchanges create. So now I'll leave Tal and Bryan perhaps to come in with their views.
I guess I could take a shot at it. Thank you for that lead in. Sticking with the US, and then we can talk about around the world and even some other non-equity markets. Starting with the US, you have two categories. You have the public market data, which is the securities information processor, and then you have all the proprietary data feeds that the exchanges spit out. I would say if you talk about Europe, and even you look at the SIP in the US, it is such a great model to have a public quote that everybody can trust and is centralized and is a reference quote. You mentioned, Jim, in Europe, how Europe hasn't gotten to that stage yet. Canada has just, gotten their arms around somewhat of a public quote as well. So let's start with the good of the US equity markets. Now, there's still a lot of debate on how do we improve the SIP. You can always make a good thing better, for sure. That means giving the industry, brokers, a seat at the table on how the SIP is governed. And I think the exchanges are in favor of that. And then there's how do you make it faster, better, such that the SIP, the public quote, is just as good as the proprietary data feeds. Now, you're talking about a lot of telecommunications and physics where it's hard for every ounce of data to be at the same speed because they're all spit out of different data centers and so on. So you're talking about really in the weeds type of stuff. But I'd say from the most part, the US equity markets, market data is probably about the best in the world, the best model in the world internationally. If I can skip off of equities for a second, you look at dealer-driven markets, whether it's FX in Chris's world, in fixed income. When there's no centralized data, the dealers become quite protective of the data because that's their edge. They don't really want everybody else to glean information of what they see. That's their informational advantage, which has really been democratized, at least in US equity. So I'll get us started there. And Tal, not sure your perspectives there.
Yeah, maybe this is our softball question, I guess, on data. So I'll start where Nandini started, actually, which is when we think about data, the starting point is what's our role as an exchange? And if our role is to enhance price discovery, we think about all the things that we can do to enhance market quality so price discovery is optimized. So the pricing programs we put in place for trading, the way that we optimize our technology on the matching side, all is designed to ensure that we have the highest level of market quality and that our data is valuable. So that's kind of what goes into it. And I think that's what she was referring to. And that's what we're always focused on. That's why we kind of think about it from a platform pricing perspective. Everything we do is to make sure that we can bring buyers and sellers together in the best way possible and that the data reflects what's going on in the market in the best way possible. So once you've established that, then there's a question of, all right, from a SIP perspective and a prop perspective, as Bryan mentioned, they serve different use cases today. How do we make it better? The exchanges, before the SEC put out their two proposals, the January proposal and the February proposal, we were making progress on governance. I think we agree broadly that there needs to be a better governance, broader governance on the SIP, more transparency on the SIP. The financial data associated with the SIP is now out there. We've all made investments in the SIP itself, so it's much faster, much more resilient, and the higher capacity, if you will. And so all of that's been positive. And then if you kind of look at the proposal And when we talk about a distributed SIP and then a competitive SIP, I think the exchanges broadly are behind the distributed SIP. So we address things like geographic latency and geographic arbitrage. But when you start taking it to the point where you're now looking to fragment the SIP, and there isn't a gold standard anymore, a gold standard MBBO, and actually by creating competition amongst competitive SIPs in the same data center, in the same location, you're actually creating an arms race in itself, and almost like a two-tier market. So we've said to the SEC, we think where you're heading is right. We understand what you're trying to do. We can get behind some of these proposals. We think you've gone too far in some cases. And in other cases, there's unintended consequences and there's a cost benefit that needs to be done, that needs to be well understood. And the competitive SIP is a good example of that. So that's where I think we're going. We made progress before the SEC had those two proposals. I think we'll make progress going forward on governance and what the SIP looks like. The one other thing I might just point out is that that proposal wasn't in isolation and didn't focus just on market data. It was almost like a reform of Reg NMS through the lens of market data. And so I think we need to detach or decouple that as well as we go forward, because otherwise all we'll end up doing is reforming Reg NMS through the lens of market data, and we're not sure that that's actually the best approach to do that.
And Chris, do you want to look at it from the bond market?
Yeah, you know, it's interesting. The SEC spends a lot of time on data, and more, you know, over the last couple of years, they've been very focused on market data, in particular equity market data. And when I look at the universe of securities that they do regulate, securities markets that they do regulate, the bond market is the least transparent market of all our markets when you really think about it, for its size and the fact that these are registered securities. There is no, there's a last sale, there's Trace, which was innovative in its time. It certainly brought a lot of transparency, but there is no bid offer in the bond market. There's not a real-time quote. So we're spending a lot of time on the U.S. equity, you know, consolidated quote and what it costs. But there's really been no focus on what I think is, you know, fairly dark pool, which is called the bond market. And because if you think about how bonds are traded, there are some very small retail markets that have actual quotes live, but the vast majority of the bond market is traded through a private request for quote market. So every institution will ask for prices, and only that institution sees those prices. So it's a very unique market, considering it's so much larger. There's so many more investors in bonds, either directly or through their retirement accounts. And ironically, we spend a lot of time, and unfortunately, Bryan and Tal have to talk hours about defending the thing that works the best, which is the consolidated quote in the equity market. And it doesn't cost that much for people to buy, particularly retail. So when you add up the P&L of Wall Street, it's giant compared to the cost of market data. So the complaints are interesting to me. But they're all directed in the wrong place. The transparency in our markets is what makes our markets work so well. It's what make our spreads so tight. And it's the markets that are less transparent that the spreads are wider and investor costs are enormous. So I think the days of asking about the cost of market data are coming to an end, honestly, and there's a new day where we're focusing on more transparency, not less.
So do you think that thing that works the best in the equity market should be transferred to the bond market as well?
Right now, there's no way to form one, right? We formed a bid offer price that we call CP Plus, and it's really it's a real-time quote where you can see the bid and offer side of the market in the bond market. But there's no market that organizes price that way. The market is typically, if you look at even Bloomberg and IDC owned by ICE, it's really a last sale quote. It's a last sale price feed, not really a predictive, where is the market now? And that's part of the uniqueness of the bond market structure. There's no organized market in the bond market other than really MarketAxess, where we organize all of that RFQ information and form a bid and an offer. But we certainly don't want to replicate the SIP in another market when there's so many complaints about the SIP today. But there are things that I think regulators can do to bring more transparency to the bond market.
Thanks. Let's move into another area. Recently, we've seen many legitimate financial institutions go into the crypto space, or the so-called digital asset space. So where do you see this going?
Let me start. I mean, I think it's a really welcome space. I think crypto is another asset class. You don't see a new asset class every day. So it's great. I think harking back a little bit to Chris's comments on those helpful comments on market data, if I could just say that really what we need to do, I think all of us, if you look at the crypto space, is to focus on a couple of things, including perhaps a common taxonomy, and to look at some kind of standardized definition, some kind of harmonized guidelines, best practices. And I think for there to be a clear understanding that this would be a market which is global, and therefore the ability to have regulatory arbitrage between different jurisdictions would be very unfortunate. But apart from that, I think we need to focus on making sure that the market, or as a product, it's a product that is fit for purpose, and investors are being treated well when they come in to a market like that. But those are regulatory issues that should be kind of ironed out, and can be ironed out with. I smile because I say I'm going to call it relatively simple, but things like a taxonomy, or like agreeing common definition, and agreeing, whether a particular asset is actually equity-like and therefore it should be treated like an equity, etc., is complex. But apart from that, I think it's really welcome. What we have seen with kind of Robinhood and the whole retail phenomena is that you're seeing a generation of investors come into the market who traditionally, have not been interested in the market or in Wall Street, And I think anything that taps or piques that interest is only good. And long-term public markets, which are transparent and are trying as hard as possible to be efficient, should kind of embrace this kind of innovation. But let me turn to one of you.
I can start on this one. So it's interesting because it's worth separating the asset class from the technology, because the technology can serve as a platform and has its own separate set of use cases. And so as an asset class, I'll just touch on it and then I'll move on to the platform. So what's interesting, just observation, is Bitcoin is what, $18,000 today, or 17 something, depending on the price discovery that you have out there. Now that's up 70%. It's been above 10,000 for quite some time, since probably the middle of summer, but no one's really talking about it. And what's really interesting is gold and silver, I think, are down this year. So gold and silver are down and Bitcoin is up substantially. So there's a dislocation. So when you think where investors are putting their money, or where they're saying, hey, this is not going to be subject to QE. So we printed in 1 month $1 trillion, and we all know that and see that. And now you're asking the question of like, well, is gold the safe haven? Well, gold is down and Bitcoin is up. And that's just a really interesting observation around the stability of the asset, what's gone on, and how it's different from the melt up we saw in 2017, where you probably had like 5 or 6 days where Bitcoin was at 10,000 and it just ramped up to 20. Now Bitcoin's been up above 10,000 for some time, tracking towards 20, but nobody's talking about it. And it's less volatile than it has been in the past. So we have to start like changing the narrative around how we think about this asset class. It's still young. It's still maturing. There are concerns about manipulation. There are a lot of unregulated exchanges. There are use cases for the black market and other things that we might not be crazy about, but we just have to understand where the future is and where it's going, which might end up and lead to an ETF product at the end of the day where retail can then access it. So that's kind of been the holy grail there. On the platform side, what's interesting is everybody's seen the use case for DLT right from the start. But what they did is they kind of like course corrected between 2015 to now and said, well, maybe we can use it for all these other things that are not broken and work really, really well, where the technology in play is actually far better than what DLT could offer. And so that's where I think there's been a misstep with regards to the progression of the platform. But as we stand here today, we're still looking for use cases for the platform. And I think it's going to come on the post-trade space. You know, ASX has been working on it for quite some time. I think there's some promising work here in the US on the post-trade space. You have folks like DTCC talking about it, and it makes a lot of sense. That technology fits really well for the problems they're trying to solve. On our side, we've gotten questions about markets being run on DLT, on distributed ledger technology. Well, we have a lot of great technology already that provides price discovery for really liquid assets, and we just don't see that being a compelling use case on the front end side for many asset classes as we do in the middle office and the back office side. And so that's where I think the dichotomy has been on the platform side, but hopefully over the next year or two, we start to see some of these solutions come to market and we start talking about decentralization in a bigger, broader way.
Jim, I'll stay on the crypto side as opposed to the DLT. Some of the perspectives from CBOE is that it's about the accessibility of the product. You know, Tal makes some interesting points around this, you know, the storage of wealth and you know, gold being down, and can you really, you know, can you safely go to Bitcoin as an example? Well, you know, we've tried a number of times with an ETF that would open up accessibility to the product, particularly for both retail and institutions. For a variety of reasons, the SEC has not been comfortable yet with the underlying markets that are the exchanges that are trading Bitcoin that the ETF would link to. The other point I would make is just it has been a retail product. If you look at the crypto exchanges, it's basically all retail. And when we had a future, so CBOE had a Bitcoin future for a period of time, and we delisted it for a variety of reasons, it was all retail. So there's really no institutional money that I've seen in the Bitcoin and in the crypto space. A lot of it is just, you know, worrying about trading on the exchanges themselves. You know, I think the institutions would be clamoring for a SEC regulated product. You know, we have a CFTC regulated product on CME that's live, but you know, it's still a different client base, people that are trading futures versus that are trading securities. So I think we haven't got over the accessibility hump to be able to take advantage of the points that Tal made.
Now, moving into the past, once upon a time, long ago in the 20th century, the United States used to have a financial transactions tax, but a Democratic Congress with a Democratic president got rid of it in 1965. Yet, it seems like a younger generation doesn't seem to want to learn the lessons from the past, and we see people calling for a return of such an atrocious tax. So what kind of harm would a financial transaction tax do?
I'll jump in here, even though the bond market has sizable spreads to pay for a tax, but financial transaction tax, and to be clear, Jim, there really is a tax in the securities markets today. There is a transaction tax that the SEC collects. We typically refer to it as the SEC fee, and it is on transactions. It's just quite small and adjusted to a lower, and it helps fund the SEC. But the financial transaction tax, depending on how you calibrate it, can be devastating to the markets. If you look at Europe for a number of years post the financial crisis tried to implement a financial transaction tax. They just couldn't get it through all of Europe. There was some very strong political wills opposed to it. And then there were some countries that actually went ahead and implemented it, like France. And the outcome is pretty telling. The collection was much lower than the expectation, and the impact was just a widening of spreads. So the irony here on financial transaction taxes is that the investor pays twice. And the way that works is most taxes, the investor gets an explicit tax on their confirmation that they have to pay that tax. So the investor pays once explicitly. Now, dealers are smart. Dealers sitting in the middle don't want to pay the tax, but they know they have to pay the tax. So they increase the spread by the amount of the tax. And everyone has that in their formula, and they will instantly increase the spread. And we saw that happen in France. And who pays the spread? Well, the investor. When the investor comes into the market, they pay the spread because they're typically crossing the market. So they pay the tax on the transaction at time of execution, and then they pay the tax because it's explicitly in their confirm, and they have to pay the tax on the trade itself. So unfortunately, what the politicians that support these financial transaction tax, they don't tell you is the investor pays it twice. It pays it for Wall Street and it pays for themselves. And that's just not only unfair in terms of how you allocate that, but it also does damage to the cost of the market, and it can actually reduce liquidity in the market. So all around where they've been implemented, they've failed to collect enough, and they've also did more damage than benefit ultimately.
And it's interesting to see how country after country flirts with it and then either abolishes it or cuts it dramatically. Tal, you were about to say something?
Yeah, I think, so we're going to finish where we started, which is, it's really interesting. At a time where markets have performed well, markets are up, retail is a big part of that. We're looking to now go after that part of the market. Like Chris was saying, we're going to go after Main Street effectively, which is retail investors and institutional investors. And it's not like smart people got in a room and came up with bad ideas. It is a force of nature here with the pandemic. So we understand and we empathize with each state and the fiscal condition they're in. Like, that's number one. We always understand that these individuals are trying to do what's best for their state. What we're trying to do is educate them on some of the things you just heard, which is, in the past, these taxes have, one, never collected what they're projected. Two, have always led you to a worse off position in the long run. Because that liquidity, that business, if it's portable, will go somewhere else, whether it's another state or another country, and it won't come back. And by the way, if the tax is big enough, you'll hollow out liquidity, you'll reduce market quality, and you'll have another set of issues or a whole set of issues that you've created as a result of that. And then in the New Jersey case, what's really interesting is it's a nationwide tax. It's retail mom and pop in Nebraska and maybe, some large asset manager in Boston coming together, and just, they happen to consummate that trade in Jersey. And as a result, we're going to tax them for that. So I think Bryan's point, he brought it up early, we are mobile and portable as an industry. And we as an industry, as an ecosystem, we're obligated to get you the best execution at the lowest price. And if we can avoid that friction, we will. We will. So you won't collect it. It'll leave you worse off. And by the way, it's not a nation building tax. Sweden did it in the late 80s, and they found out they lost to London. And so every time it's been demonstrated to not deliver what you want, I think what people go back to is the short term, like, what if I did it just for a year or 2 years? That won't be too bad, right? It won't actually harm you. There's no such thing as 1 or 2 years. Once it's on the books, it's always on the books. Look at New York. It's been on the books for a really, really long time. And I think the government, the legislature actually has to make a decision as to whether they want to implement that or not, and they haven't. But that's the thing that worries us, and that's what's going to drive us out of a jurisdiction.
Right, thank you. We have 10 seconds left, so one quick lightning round question. This one came in anonymously for Chris. Chris, after you disrupt the bond market and raise market data fees in the bond market, what asset class will you go to next?
Well, I was just thinking of the oil analogy, and if oil is data is the new oil, then we're just starting to frack in the bond market to extract some of that oil. I can't tell you where I would go next. I have a long road ahead in the evolution of the bond market, and there's a lot to get done there. And things aren't even electronic. You can't have data until you have orders that are off the phone. and in a computer. So it's a long ways off.
All right. So thank you all very much. I want to thank all the panelists for an amazing job. And with that, I will turn it back over to Professor Agarwal.
Tal and Chris and Bryan and Nandini, Jim, thank you so much. That was a really interesting and very useful discussion. Really appreciate. And I guess each of you have been at our FMQ conference several times in the past, and we value our partnership very much. So thanks a lot.